Thank you very much. As was just said, I've been now 10 years pretty well working all the time on wealth issues. This is something which I started actually when I was a PhD student. So 50 years ago I've been working on the same subject, which seems rather boring to stay on the same subject, but of course I have diverted in the meantime onto other sorts of more technical issues. We always find something, I think, quite interesting to report, and this might look like a sort of glossy corporate brochure, but let me assure you that there's quite a lot of hard facts and hard research that lies behind it, and that's what I'm going to talk about today. So if I can work out how to operate the system here, I think I'm going to talk about wealth levels, wealth distribution and wealth inequality, which just about covers everything, but in particular it's a global perspective. We try to cover these issues for all the countries in the world, and so we can start to discuss what's happening to distributions and levels throughout the world. I need to just do a little bit of housekeeping at the beginning, just that we're all on the same page when it comes to discussing concepts and things, because sometimes people hear the word wealth and they associate it with income, and so we want to make quite a clear distinction. We're not talking about income, which is a flow. We're talking about wealth, which is a stock, and we're talking about household wealth. So it pretty well corresponds to what you would do if you tried to draw up your own household balance sheet. You sat down, say, the end of the year and said, okay, what are we worth? How much is our house worth? How much have we got in the bank? Do we own any shares? Do I have some life insurance, or life insurance possibly? What about pension funds? And then I've got to worry about debts as well, mortgage debt, loan payments, credit cards, and you get a net summary of where you are. So we try and do this. We're thinking of trying to do this. So it's not income, which is what you obtain or get or receive during the year. It is this stock. The one area where we perhaps need to clarify is we don't include what is called human capital, which, in other words, what is essentially the value of the various attributes that people have. So we're not, anyone that understands human capital, we're not including human capital. It is actually things that you can measure and value right now. And also, there is some issues about pensions. State pensions are not typically included. Partly this is simply because when countries draw up balance sheets, they don't include that either. So we're just accepting some constraints there. So there are issues about exactly what's included and what's not included, but broadly speaking, the main thing is it's wealth, not income. We talk a lot about the level, the average level in different countries. We talk about the distribution in different countries, and then we aggregate these together. We focus on the adult population rather than the normal full population. The reason being here is that wealth on the whole is owned by adults. A lot of children don't own wealth in their own name, and on the whole it's, I think, more appropriate to think about the distribution across adults than it is about adults and children together. Another issue is, what do we use to measure it in? And since we're comparing different countries, we have to have a common currency to convert and compare. We use US dollars. In the past, we focused very much on US dollars at current exchange rates, but we have some discussion this year on converting it into real dollars so that we have converting it onto the base in some sort of year. Let me also, again, try to just briefly give you an idea about how we approach this subject. What we first try to do is say, okay, can we get an average wealth value, or total wealth value, or an average wealth value for each country? The best source of this is what they call country balance sheets. They're called household balance sheets. An increasing number of countries have these. There's, I think, if we include just on financial wealth alone, we're talking about 40, I mean, maybe it's close to 50 now. When we look at the other non-financial assets, which is mainly property, housing, land, there is a smaller number, but there's, I think, 20, 25 countries with complete balance sheets. That's very good because it's an independent estimate. You know, people sit down and say, okay, what is all the land and buildings worth in this country? How much of that is owned by residents of this country? How much do residents own property abroad? And they do that for each category of asset. So it's an interesting exercise, and it's one which, I say, an increasing number of countries are adopting. Where we don't have balance sheet trait data, we try to estimate the wealth, the average wealth in each country by using the standard regression techniques. And so we have a model. We do this for financial assets, for non-financial assets, and for debts separately, and then combine those to get a figure for the net worth of each individual and the net worth of the country as a whole. We then look at the distribution. This is a slightly more problematic because we have in the world something like 180 countries, I believe, that have some sort of income distribution data, but wealth distribution is much more limited. Around 30 countries, I believe, have wealth distribution data. So what we do to try to expand that is to think of trying to use the income distribution data to get an estimate of what the wealth distribution would look like. There is some relationship between the two where we have data for both. In almost all cases, I would say, wealth inequality is greater than income inequality. So we try to predict what the wealth inequality is from the income distribution statistics. But then we do an extra level of complexity, and that is that the wealth distribution data and the income distribution data typically come from surveys. The surveys underrepresent people at the top of the distribution, and they often undervalue what their incomes are and what their wealth is. This is just known for a very long time that these biases exist. So unless sometimes some countries are pretty good at adjusting for that. The US does a very particularly good job at improving the sample techniques to overcome that problem. But in other countries, it seems that there's quite a big discrepancy, and you can pick this up in various ways. So I think everyone recognizes this problem. So what we do is to try to compensate for this lack of data at the top end by using another source of data, and that is the Forbes billionaires, the number of billionaires. And we use that data for different countries. We track how that's going through time, and we make an adjustment for the top end using the billionaire data. So this is not just a very simplistic exercise. It's quite complicated. We've described this in a number of presentations and journal articles, but it is still at the frontier of what people do in dealing with these things. So we're ending up at the end with something which we think is the distribution of wealth in different countries, which is consistent with the evidence we have from surveys and also consistent with the evidence we have from these rich lists, of which the Forbes is the best known. Okay, that's all of the boring things, and so we can start now looking at some of the results. And the first thing here is a map of the world. It is in the report. What this map just says is we divide countries and we just group them according to their level of wealth. And the countries, the black areas, I'm afraid a few years back we had some lovely colours on here, but Credit Suisse now have what they call a sort of corporate policy, which means they don't allow any nice colouring, and we have to put up with just shades of blue and white. So it's a somewhat limited range of colours, makes it not so easy to capture, but the black ones are the rich countries, the wealth-rich countries. Of course, these are really not so dissimilar from the income-rich countries, so high per adult wealth is going to be related to high per adult or per capita income as well. But there's basically, it's North America, it is Europe, particularly Western Europe, and it is the richer Asia-Pacific countries, of which Japan, Australia, and Korea, and places like that are the leading contenders. So they're the rich countries. The next group now are the ones which in this sort of green colour here. So we've got Mexico, we've got a little bit of, it's the blue, what are we talking about? The next colour is the greenish colour. So we've got Mexico, we've got some of the parts of Latin America, we've got a little bit of Eastern Europe. I think probably Poland would fit into there. And most importantly, we have Russia and China. These are countries which didn't used to have quite such high wealth, but have now migrated into that range. The third level are ones with, these are average wealth between $5,000 and $25,000. These are the bluish areas, and you see most of Latin America is in that category. There's a bit of the top part of Africa and the bottom, South Africa and the Mediterranean, the super Sahara region, I suppose you would say, is in that category. And also India would be a big part of that. And then finally there's the ones which are the lowest wealth ranking, and these have a wealth per adult less than $5,000, and they are pretty well. Africa is almost all in that category, but there's other parts of South Asia which also fit into that group. So there's a very strong regional dimensions to wealth. There are certainly some obviously rich wealth regions and some poor wealth regions, and pretty well there you are, the usual suspects in that if you were looking at income, you'd draw up a very similar sort of map. Now we go, because we have more, once we combine our levels information with our distribution, we produce a sample. I call it a synthetic sample because it's not an actual sample that you would get from a survey, but it's now predicted on the basis of what we know about the distribution and the level. We can create a sample for that country which would exactly replicate what we know. And we can do this, and we do this for the whole world, and we have a sample of 1.4 million observations, which we then process to get some idea about the distribution. And this is captured in the report in the terms of a so-called wealth pyramid, where we have a group, we sort of compute how many people are below $10,000. these are not countries below $10,000 now, we're now talking about individuals. How many people in the world have between $10,000 and $100,000? How many have between $100,000 and $1 million? And the top of the triangle there, the top of the pyramid, is those who are dollar millionaires. You'll see from the pyramid that, or at least if you look at the numbers in the report, you'll see that there's a little bit under, there's 56% of people in this bottom category. So more than half, close to 2/3 of people are in this bottom category with less than 10,000 US dollars in terms of their wealth. That part of the pyramid is actually used to be bigger. So what's happened over the last 20 years is people have migrated, have tended to increase their wealth, and so they've moved from this bottom tier up, further up, and on the whole, the tiers above have all expanded. But of course, in the middle tiers, they gain some and they lose some. The big influx into the bottom tier is really new population growth in wealth-poor countries. So there is a correlation. Very often, the countries which are wealth-poor are those which are whose population is increasing fastest. So you get a tendency for that bottom group to expand, but at the same time, people are migrating further up as wealth grows over time. At the top, we now have a situation where the top people here, which are 0.9%, so just under 1% of the world, people, 1% of adults in the world are now millionaires. So when we talk about the top 1% of wealth holders in the world and millionaires, there's not much difference between those groups. They're very overlapping now. And they own some 44% of all the wealth in the world. So this less than 1% own 44% of the all assets in the world. If you look at the bottom here where I said it's almost 60% of people, and they own less than 2% of all global assets. So there is this huge difference. Wealth inequality is well known that it's considerably higher than income inequality. So this is really just reflecting that. So I thought what you would like to know is, where are you in this world wealth pattern? And so if you ask yourself, what do I need to get into the top half of the world wealth distribution? The answer is just $7,087. That's really quite small, isn't it? Even poor, impoverished students might find that they can get pretty close to that. Remember, you're supposed to be adding in your mobile phones and your bikes and things, and perhaps your designer clothes. You're probably up to something on that. These things actually don't get valued very well in the survey, so you probably have to have more to be officially in that category. But it isn't a difficult level to be at if you are in a developed country. To be in the top percent globally, $109,000. Again, anyone that's had a little bit of a property for a few years, anyone who's been putting some money away, probably that isn't beyond their expectations. But to get into the top 1%, you do need to be pretty close to being a dollar millionaire. And remember, we're here talking about per adult, so if you're in a family, I'm afraid it's not enough to have $1 million between you. You've got to have $1 million per person to get into the top 1% globally. I thought I would just do the same things for the UK, and I'm afraid, you get quite shocked at this numbers, I think. At least I was. I was surprised. if you have less than $97,000, which is what, say, £80,000 per person, you're not even in the top half of the UK wealth distribution. If you want to be in the top 10% in the UK, you have to have something like £500,000 per person. And if you want to be in the top 1%, it looks like you're going to have over £2 million per person. And, well, that is serious money. So this is the numbers that we are coming up with, and I have some faith in them, but I was a bit shocked, nevertheless, when I computed those today, thinking that they may be of interest to you. I don't know whether that makes you feel rich. Probably it makes you feel very poor, but there you go. That's maybe one thing you might remember. Because we're able to create this sample, we can also now do a sort of distribution of people across the world. Now we're saying we take each person, we know their wealth level, we know the country, so I can now group them together and put them, count them up at various points in the world distribution. So here is the bottom of the distribution, and on the whole, if we look and see what people are in there, it's heavily India, Africa, and the low-income Asia-Pacific countries dominate the bottom part of the distribution. In the middle, it's really noticeable that China dominates this, particularly the middle segment. As it happens, having been doing these diagrams for now a number of years, it's been quite evident that as the years go by, this big China blob moves to the right. I mean, as the wealth in China increases, the people gradually move up and up in the global wealth distribution positions. And it's quite interesting to compare, I think, China with India, simply because their populations are somewhat similar, and they, at one point, were quite similar in their stages of development. But China now is considerably above India. India is still pretty well stuck in the bottom half of the global wealth distribution. When you get to the top end, again, you get a total difference. It is North America and Europe that dominate the top 10%. This top 10% is spread out a little bit here, so there's a little bit more detail, but you can see here just how dominant Europe and North America are, with a few of the richer Asian Pacific countries like Japan, like Australia, in there as well. Another point to note, perhaps of interest here, is that at the lowest end, you actually get quite a lot of people from the so-called rich world. You've got North America, you've got some European and Latin America, well, particularly North America and Europe. And that's a trend which has become more apparent over the years. And that's really because, it's largely because I think we have students who are racking up debts. We have other people who are taking out loans. There's quite a lot of people with negative wealth in the advanced economies, and it is easier for them to acquire debt and to get into these situations. So when you look at the numbers that we're reporting, we get a lot of negative wealth observations in developed countries. I think Scandinavia is a very strong example of this. They seem to encourage students to take a lot of debt, and they have no real pressure to repay it, so they rack up, they seem to have negative wealth for a large number of people and large number of years, parts of their life. So, let me now move on and say, each year we try to do a different sort of topic, and in the past we've covered all sorts of things like the impact or the sort of portfolio composition, the sort of assets that people own, the division between financial assets and non-financial assets. We've had sections on women, we've some sections on age, so we do special topics. This year, sorry, because it's our 10th year anniversary, we decided to take a sort of harder look at what are the factors which underlie the trends, the levels and the trends that we see. So can we then try to identify some of these factors and talk about them in more detail? And there's one chapter which looks at, it's called The Evolution of Average Wealth, and the other chapter is called The Evolution of Wealth Distribution. So and so I'll talk about these topics. So one of the first thing you might, when you're looking at wealth levels over time, you might ask yourself, what determines whether a country has a high or low level of wealth, and what determines whether they've been growing faster or slower than other people? Thank you very much. That's very welcome. And if we look, this is, say, over the last 20 years, looking at the average growth rate of different countries, if we ask ourselves which countries have grown fastest, the answer is, actually, it depends on what you mean by that question, because we have different ways of measuring wealth growth. And in particular, we have used, if we look and see, we are measuring wealth in terms of US dollars at current exchange rates. We get one particular value in terms of what the growth rate's been. If we do it in real US dollar terms, it's going to be lower, simply because we've got to now take into account inflation, so it's going to be lower by roughly a couple of % per year, we would expect, in terms of US dollars. But we can also measure the growth rate in terms of the domestic currencies, the local currency unit, LCU in this terminology. And again, we can do that in real or nominal local currency units. And you will see here that China is really pretty strong on any of these measures. We're talking about average double-digit growth rates, I think, except for real local currency units, but typically it's high and often double-digit. But some other countries seem to do even better. For example, Russia, in terms of its rubles, or Turkey in terms of what Turkish lira. If we just looked at that, the growth rate looks pretty high. But both of those have, that's been experienced, they've been growing, and part of that is due to inflation, domestic inflation in those countries. So when we measure it in real local currency units, which is the darkest line there, both Russia and Turkey, in particular Turkey, collapse completely. So essentially what's happened in Turkey is it appears that wealth has been growing very fast, but most of that is inflation, and if you take that into account, their wealth growth is much more modest. I think another thing that I think is quite noticed, so there is that difference, and I think what are the countries, the ones which really would appear to have a certain amount of inflation are Russia in particular, Turkey, India, and Vietnam, where the local currency, they seem to be doing well in local currency units, but a lot of that is inflation. There's also some countries over time which seem to have had their appreciation of their currency against the dollar. So that means there's a difference between measuring in US dollar terms, they seem to be doing better than real US dollar terms compared with real local currency units. The other thing which I think one sits at this and dwells on it and thinks, what characterizes the countries that have seemed to have done particularly well? in the last 20 years. And China, India, Russia, Vietnam, they're the ones which appear at the top there. And of course, one characteristic they have in common is that 3 of them at least are transition countries. They were formerly countries where personal wealth was very limited. There were limited opportunities for personal wealth. And so one of the explanations is that they've really been, it's this sort of capitalist development, if you like. I don't know how much people know, but in a lot of these formerly socialist countries, a lot of the state assets were simply given away to individuals. In Russia's case, they gave the whole of the housing stock away to the people who were living in them. I mean, it's just an amazing transfer, and this was quite common in Eastern Europe, in the countries where they converted and went through this transition period. And Russia even also gave out little vouchers for Gazprom, their main gas and oil company. Unfortunately, after that, they gave it out to people, but they all didn't know what to do with these, and they just, so a few people went around collecting them all, and these are the people that got rich, and the people that had the Gazprom shares just sold them out for really a pittance. So it wasn't done particularly well, but at least there was the intention there, I think, of trying to, and of converting from state ownership to private ownership. And it must be, I think, one of the, I think there clearly is a case for saying this has been one of the factors which is lying behind this rapid increase in average wealth in these countries, that they have really been, is this transition from a state-based system in which people didn't have private wealth to a capitalist or a semi-capitalist system in which that is very much more common. How does this now? There are some implications here for looking at wealth growth over time. This picture here is just a graph which shows the annual rate of increase in wealth, and this is we have to compare it across different countries. I have to aggregate them together, so it's in US dollars, but it's in real US dollars, so we are taking account of inflation. And you will see here that in the first 10 years, or the first, I suppose to be more specific, the 6 years really from 2001 up to 2007, there was a very high rate of average wealth in the world. The wealth per adult on a global basis increased by something like 10% per year, which is a really fast rate. This is in real terms, remember, real US dollars. And what happened then is we had the financial crisis, and if you know anything about it, the wealth collapsed, partly through the housing market, but financial assets were particularly hard hit in developed countries. So Europe and North America suffered big hits, and average wealth went down that year. Since then, we've had a resumption. Wealth has started growing again, but it has been at a much lower level. If you look at the average level before the crisis, it is at least averaging around 10% for 6 of those years, whereas in the post-crisis period, we're talking about wealth growth of something like 5%. The other thing which is really very noticeable here, and we've only picked this up this year, and part of that is because we've now looked at it in real terms, is that before the crisis, the main when we look and see what are the regional contributions or contributions of different groups, I should say here, we've divided the countries into different groups. We've separated, China is so dominant that we've set that aside. We've had another group which we call emerging markets. There's a definition of around 20 or 25 countries which are grouped together and called emerging markets. We have then the rest of Europe, the rest of North America, the high income Asia, and everything else which is largely Africa and I suppose a good chunk of Latin America, well, in these other countries. But what is noticeable here is in the period up to the crisis, it actually was Europe that was the main contribution to global growth came via Europe. And one reason for this is that their currencies were appreciating. This was a period in which the euro grew, appreciated against the US dollar very considerably. I think it was 40% in a matter of 6 or 7 years. So there was this massive appreciation of the euro, and of course that pushes up European wealth when you measure it in US dollar terms. So in this period up to the crisis, Europe is contributing around about half of all growth in global wealth. After that, since the crisis, Europe, the contribution of Europe is roughly zero. I mean, there's almost been no real growth in European wealth since the crisis. However, what has taken over is China and the other emerging markets. China is the red colour in this diagram here. The emerging markets is the green, so if you look at them, initially they don't make much contribution to the world because they really were, they didn't have very much wealth. They had a low base, they were growing quite fast, but it was from a low base, so they didn't make much contribution globally. But since the crisis, they've become now the dominant contribution. Most of what goes on in terms of real global growth has happened in China and the other developing markets. Roughly 2/3 of all the growth since then is due to those groups. And it's the US that's contributed the rest, and the other contributors here, Europe, high-income Asia, and these other countries, they just net out basically to zero. So there really has been, and I was struck this year really forcibly, and partly because you don't notice it so much when you look at nominal wealth growth, but when you put it in real terms, we really have had a total change in the situation. We've had now a switch from what one would call the old world. They were contributing to wealth in the period up to the financial crisis, and now it's the new world that's taken over, although I suppose it's a bit inappropriate to call China the new world since they were there and at a higher stage of development centuries ago. But I think you probably perhaps allow me a little laxitude there in my descriptions. So we do, it's really quite interesting when one starts to look at this and say, okay, we've got two things here. We've got, if you like, a golden age, the first 10 years where we had high wealth growth. Actually, it's even better than that because it was really quite inclusive. All parts of the world grew at that time, and also lots of people. It wasn't just the rich who were benefiting. It was all parts of the wealth pyramid gained during this era. So it was a sort of golden age in which everything you would like to see happen in wealth changes over time seemed to be going on. Since then, and we'll come back to this, but after the crisis, we've had a much lower rate of growth, and inequality has gone up, and that part of that is because there's been a change in the sort of assets which have grown fastest. Before, in the years up to the crisis, it was non-financial assets which grew faster than financial assets. In the period after the crisis, it was financial assets that grew fastest, and growth of financial assets tends to benefit richer people because they hold a larger proportion of their portfolio in financial assets. So these are, one does try to get some interesting insights, I think, into these factors which are explaining what happened in terms of global wealth. If we now just ask ourselves a little bit about if we delve down a little bit further and ask ourselves what perhaps explains why countries, or what sort of factors would we like to take into account in determining wealth growth. The first thing is, on the whole, you would expect countries their wealth to grow fastest if their income is growing fastest. As a country is growing, it gives opportunities for businesses, investments. We have incomes are growing, people are making savings, they're buying their own property and that type of thing. So you would expect there to be a link between the general level of economic activity and the level of wealth. And that's captured in the growth of the ratio of income to GDP. But we also find out that that ratio itself can be rising over time. And this is one of the central features you see in development. On the whole, countries start out with fairly low wealth to GDP ratios because they have poor institutions, they have sort of uncertain property rights, it's not clear who owns various sorts of assets, in particular land. They don't have very good financial markets, they don't have very good financial sector, so people find it difficult to save and in particular to borrow, so they have difficulty investing and growing their businesses. So for all these things, there's sort of quite limited opportunities for people to make investments and develop in that way. But as countries develop, that ratio tends to increase as the institutions improve and as the financial sector expands. And we see this, it's going to be in some of the data there as well. There's I've already mentioned the sort of emergence from transition as being one factor where you think that might explain high wealth growth. Population growing and aging, if populations grow, that sort of gives more opportunities for businesses, it gives a bigger market. At the same time, of course, the population is growing, it means wealth per adult is going to be divided, wealth is going to be divided by a larger number of people. So there's two offsetting factors there. The savings rate, well, I'll come back to that, but you would expect, in some sense, countries that have high savings, wealth in effect is just accumulation of past savings. You can think of this is what individuals do. Not quite that straightforward because there's also capital gains and things involved there, but on the whole you would expect countries in which households have a high savings rate, that would be converted into wealth and means that their wealth would grow at a faster rate. There's also, I think, another issue about women. In the past, women have had fewer opportunities to hold wealth. Their wealth levels have been relatively low compared with men. There is evidence that that is now improving, that the ratios are at least moving up. And again, that might be a reason why wealth in a country might increase because women are getting a better opportunities. The other ways in which wealth might increase is if we have asset price inflation, which means there's no change in the real level of assets. It's just that what we have is valued at a higher level. So this would be houses in particular and would be various sorts of shares. And again, I'll come back to this in a while, but what we've seen in the last this century is there's been an attempt to keep interest rates at a low level. Inflation has been much lower than in the past. Low interest rates tend to mean that assets are worth more, so the value of assets go up, and so that could be a cause in which wealth can increase regardless of whether there's anything happening to the stock. And the same, of course, is true of houses as well. So those are reasons why we might explain what is going on there. So I've got a few slides, and these are, again, in the report that might be interesting. First of all, what is the relationship between the level of general activity and the level of wealth growth? The answer is it's very strong. Here, we're not talking about anything we've estimated. These are pure hardcore statistics from source statistics. I haven't labelled all the points, but you can see pretty clearly, even without dismissing India and China, which are very clearly do a lot to, would be a big contributor to the regression coefficient, there is a strong relationship on the whole. As wealth grows up, as GDP goes up, so does wealth. However, as I've said, it's not a straightforward relationship that over time, this wealth to GDP ratio is not fixed. It actually can change. And the history of development and the history of the last 20 years is very much along those lines. We can see that from, if you just look at China there, the third column, China is being such that it started out initially 2000 with a wealth to GDP ratio of about 3, and it is now gone past 4, about 4.5 now, simply as it has developed, and for all the reasons I've suggested. There's really sometimes quite a virtuous cycle here. As countries develop, their institutions improve, that itself increases the wealth to GDP ratio, and that feeds back into more growth in terms of GDP and wealth. So there's these things are the sort of cycle in which countries go through growth would be picked up there. Emerging markets, again, there's evidence that they're not just standing still, their wealth is not just increasing in line with GDP, but actually that is rising. When you get up to the more developed countries, you'll notice that once you get to about 4, things seem to be ease off a little bit. I mean, there's a suggestion, I think, from just looking at this data that 4 is a sort of, once you've passed that level of 4, it starts to, there must be some other reasons really for that going on. In other words, we're talking about countries that have pretty good institutions, pretty good property rights, pretty good financial markets. So what else is driving those wealth to GDP ratios above 4? And I mean, I think the answer here, at least in the last 20 years, is that part of that is asset price inflation. This is what we have seen here. The reason why that's growing is because we have had a situation with low interest rates. We've had sort of quantitative easing that's being supported in this, and this is supporting high asset prices, and which mean that you get these higher ratios. There is a implication from that, or a consequence of that, is to ask yourself, is that going to continue in the future? Is it the case that what's going to happen when, if we ever get to slightly higher interest rates, if we get to, if quantitative easing is reversed, that at least there's a serious chance that we will have, that these asset prices will start to dip a little bit, and that we will find that wealth is either slowing down or possibly even recording negative growth. So, again, I think this is interesting. I've never actually ever seen, I think, a discussion of this ever, but for when you're interested in development and interested in global issues, I think even, I have to say, strikes me anyone that wants to write a little economics paper, you could perhaps link these changes in the GDP, wealth to GDP ratio with other indicators. We have a number of indicators of the level of development, institutions in different countries, degree of bureaucracy, whether there's the degree of honesty and so on in corruption in different countries. So if one just did some simple regressions on that, I think might be some interesting results would come out of it. We have also done it for individual countries, and again, I think that just confirms what, at least my impression here, that 4 is the sort of level which is sensible. When you start to get above that level, the little alarm bells ring, at least in my head. And the exemplar there is Spain, for which, on our data, the wealth to GDP ratio went up to 6 in the period just after the financial crisis. And I think Spain has suffered a lot in the last 10 years. They've had some really serious economic recession, and they've really been trying to unravel all of the problems that they built up with a very extensive property speculation in Spain. So there's a sense in which I think one could use that and say that is a lesson here for countries that get above that level. In other cases, it looks like they're higher than they used to be, but whether or not that is a temporary situation or whether it's a permanent move just remains to be seen. However, again, I just commend it to you that I think this is interesting set of data that could be explored in more detail. The other thing that we have here is we report on is the savings rate. And again, I said there's a tendency you'd think savings rate ought to be related to higher savings rate, higher wealth growth, and that is indeed what you get from this simple, this is of course not a serious economic analysis here. We haven't done any, we're not controlling for other things, but just a simple scatter plot suggests that even without China, which is really an outlier on pretty well all of these diagrams, we get a fairly strong relationship between the level of savings and the level of wealth growth. And you can convert that into a sort of a suggestion about what that implies. If countries increase their savings rate by 10%, then they would get something like a 1.3% extra increase in their per year in their wealth, in their growth rate of wealth. I noticed one thing perhaps interesting is to notice the UK, which is sitting here right at the bottom, with of course the one of the lowest savings rates and also one of the lowest growth rates. So there's some sense the British experience is sort of confirming these things. At the same time, I should also say I'm never particularly happy with savings data. One problem with savings rates is it's not always clear whether they include capital gains. And so you can easily have situations in which people's wealth goes up because they're getting capital gains, their houses are increasing in value, and they may consume part of that. So it looks like in those cases the recorded savings rate may go down, even though really it's because they're neglecting the implications or the consequences of capital gains.